How I Made $2 Million in the Stock Market.
Author of How I Made $2 Million in the Stock Market. A professional dancer who later turned into a professional stock trader, famous for what is now known as the Darvas method. Fundamentally, a trend-following system with an eye on price and volume. Originally published 60 years ago, Darvas turned $10,000 into $2 million. To put the performance into perspective, if we considered inflation, the title of the book would now likely be called How I Made $46 Million in the Stock Market. How did he do it? Let's take a look. We present How I Made $2 Million in the Stock Market by Nicolas Darvas. Darvas, originally from Hungary, trained as an economist in the University of Budapest. When he wasn't dancing, Darvas read over 200 books on the markets, spending as much as 8 hours per day studying. He attributes much of his success to the methods taught by Jesse Livermore, and with some tweaking he created what he calls the box system. We look at the specifics of this system and apply it to some more recent stocks to see if it has stood the test of time. Many traders and investors alike try to buy at the low and sell at the high. In theory, this is sound advice, but in real life it is almost impossible. Darvas says, "I never bought a stock at the low or sold one at the high in my life. I am satisfied to be along for most of the ride." As we will discover in this video, Darvas only seeks to capture some of the move, and with good money management he is able to capture large, unpredictable increases and avoid large, unpredictable declines. Let's look at a chart example presented in the book, in which Nicolas Darvas traded and applied his box strategy. Here we can see the company OVTLYR, and although presented on a weekly chart, Darvas says the strategy can be used on any time frame. Darvas learned that OVTLYR had been selling huge quantities of Kent and Old Gold cigarettes. Cigarettes were a high-growth industry at the time, and OVTLYR's stock reflected this with high demand, seen here at point A with a spike in volume. We will look at the formation and criteria of the box strategy in more detail shortly, but first, let's apply the boxes Darvas used on the chart here. Darvas recognized that a box had formed, and price broke through the upper part, seen here at point B, accompanied by high volume. At this moment, he purchased 200 shares at a price of $27.50 for a position size of $5,500. He also placed a stop order at a price of $26 here at point C.
Okay, so to this point here, right, figuring out where the entry point would be and knowing exactly where the exit point would be. Key takeaways before we get into this video at all. And of course, hindsight's 2020. We can see that it went up from here. But at the time, you don't know. You do not know, right? And it's exactly like this, right? Where you can hit this replay button and you don't actually know what's happening on the right-hand side of the chart until we get the Nancy Pelosi plan, which totally could happen. Totally could happen. 3.0 is pretty close to that. Maybe 3.1. But then every day that goes by, seeing, do I have an exit signal? If I do not have an exit signal, I'm going to hold it. Do I have an exit signal? If I don't have an exit signal, I'm going to hold it. Do I have an exit signal? If I don't have an exit signal, I'm going to hold it. Why do I keep repeating that? Because I'm telling you, one of the hardest things as a trader is to sit on open profits. I've been there and I struggle. I was on the struggle bus. I had one option that was up 300% at one point a couple years ago. And I was sitting there biting my tongue, sitting on my hands like, oh, I want to take this money so bad. So, and you've probably been there, right? You've probably seen a trade that's working for you and you're like, oh, give me that money. Goes from 100 to 101. You're like, oh, that's my money. Give me, right? But when you've got a losing trade and it goes from 100 to 99, you're like, oh, I'll just wait it out. And then it goes to 95. Oh, I'll just wait it out. I'll give it a couple more days, couple more dollars. Something to figure it out. And then it goes to 90. Oh, yeah, I'm a long-term investor. I believe in the company. It'll go up. It'll go up from here, right? Right? It should go up from here. So you were so quick to grab that profit on the way up, but so hesitant to take that loss on the way down. That's why 90% of traders lose 90% of their accounts in the first 90 days of trading is they can't sit on their open profits, but they will sit on their open losses and let them go crazy, right? This is so much harder to do, in my opinion, to let your open profits go because you just want to grab it, right? It's like if you're walking on the sidewalk and you see $1 and you're like, oh, I'll take that $1. And you turn around and you go back home. But if you had walked, 10 paces further, maybe there would have been $100 on the sidewalk. But you turned around and walked the other direction because you already found $1. I'm not going to find any more dollars, right? Similar concept here. And that's human psychology. That's human behavior. And that's why it's so difficult to do. So to Nicolas Darvas's point, finding where your entry point is at and where your exit point is at. Win or lose, where are those points at? You need to know well in advance. And how do you do that? Trial and error, right? Climbing up the other side of the Dunning-Kruger effect, right? Climbing up the slope of enlightenment, saying, okay, well, this didn't work this time. Maybe it'll work if I do this, right? And then taking notes and learning from it and continuing to climb up this until you can reach the plateau of sustainability.
This gave a stop loss of 5.45%, equivalent to $300 against the position. The price eventually dropped below the high of the previous box and hit the stop loss for a loss of $300. The price ended the week with a close above the box, again on high volume. Darvas then re-entered the position here at point D with 200 shares at a price of just under $29. The stop loss was this time placed in the same position with a potential loss of $400. Further purchases were made here at points E and F before finally selling at $57. For calculation purposes, we only include the box breakout purchase at point D, giving a near 100% profit of $5,500 in 6 months, from a trade risk of $400.
Okay, let's look at this risk to return ratio here, right? He risked 400, meaning if we were to look at this, right? And I went and tweaked this morning, so we can look at option sizing as well. But this is using our position sizing spreadsheet. He risked, where's the risk at? Here we go. Total risk. So in this case, let's even break it down some. Let's go to 2.5. Let's go to 2. Let's go to 1.75. Let's go to 1.5. Let's go to 1.59. That'll work. So he risked roughly $400, yet returned $5,500. That is the way the game is played, right? It's not risking $5,500 to make $400. By selling options, this gets reversed. By buying deep in the money options, you actually can risk $400 to make $5,500. I've done it. I've done way more than that. You can risk it. You can risk a small amount to make a large gain. And that's why this position sizing spreadsheet is so important here, right? Because if you have a $100,000 account balance and you're risking roughly 2% per trade, what was that? 1.59%. And then 1.59% would be $1,590. But you're not even taking that much risk. By design, it's meant to be even lower. So you're only risking a small portion of your portfolio. So in this case, 0.4% of your portfolio to make 5.5% back in your portfolio. Pretty cool, right? That's the way that trading needs to be designed. Oh, Nico, even a better point. His account was 10K, right? That's a huge portion right there. Huge return. That's a 55% return in one trade. Good gravy. That'll get you really excited about trading, right? And so that's why having that risk is so critical. Now, I'm telling you, this was not the one stock that took off like this. No way. He was in a bull market. He had the sector that was working for him, and he had the stock working for him, right? He had all three components working together. And because he had all three components working together, that's how he caught a move like this. If you've been trying to buy anything in this market and you're struggling and you're frustrated and you're like, why is nothing working? Why is nothing working? Let me turn this off. Why is nothing working that I do? It's because we're still in a bearish trend, my friends. We've been in a bearish trend for ages. And your sector is most likely in a bearish trend. So 70% of the move is working against you. Even if you have a great stock and 70% is working against you, it's like a basketball team where 4 out of the 5 players are on the bench and you got one dude trying to carry the whole team. It's not going to happen. So let's get back to the video here.
This gave a risk-reward ratio of 14-1. In comparison, the Dow Jones only increased by 7.5% over the same period. Other than the box entry method itself, the underlying message here.
Okay. He kind of skipped over the importance of that.
Over the same period. In comparison, the Dow Jones only increased by 7.5% over the same period.
The Dow Jones increased 7.5% in the same period, right? So the Dow Jones got most of its entire year's worth of gains because the average is between 8 and 10%. So nearly an entire year's worth of gains in the time that he had this trade. Do you see why it's important to trade with the trend of the market, with the trend of the sector, and with the trend of the stock? When you layer all three together, it just becomes so much easier.
Other than the box entry method itself, the underlying message here is that by focusing on the risk, you set the platform for excellent rewards.
By focusing on the risk. Be a risk-first trader. That's what I talk about constantly.
Let's move on to the box formation and criteria Darvas uses. The first point to make is that the initial stage of a box must be formed by a new 52-week high. This would represent the top of the...
So, to this point, a new 52-week high, right? A new high over the span of a whole year. Now, why does that matter? That matters because if you are achieving a new 52-week high, that means anybody who's bought the stock in the last year is happy. That means everybody in the last 365 days who bought the stock and is still holding on to it has more money in their account than they did. That is a very, very bullish thing, right? Because we want people to be excited. We want we want everybody screaming buy with us, right? Us alone, one person alone will not be able to move the market. But if you've got enough people who have the optimism, belief, hope, thrill, and euphoria to have pushed the stock up so high, that's a very bullish sign. Very bullish sign.
The box. And if price retreats, the 52-week high would be classed as resistance. The point at which price retreats and recovers is called support. This process repeats until we see a box formation made up of numerous support and resistance points. Once an obvious box formation occurs, Darvas says to set a buy order a few points above the resistance line. Therefore, if price broke out of the box, your trade would automatically trigger without the need to constantly check price. Simultaneously, a sell order should also be placed within the box. This will instantly define the level of risk you are willing to take.
Instantly define the level of risk you're willing to take. That is so crucial. And so here's the deal, right? Dude's not buying willy-nilly, right? He's not buying just because he's got nothing else to do. I remember specifically, I was getting into an Uber on a business trip, had my iPad, and I didn't have any trades on at the time. And I was like, I got nothing else to do. While I'm driving to this business meeting, let me just put on some new trades, right? So I sold calls on a bunch of stuff, so puts on a bunch of stuff for no other reason than I had money in my account and I had some time. That is a stupid way to trade. That is an incredibly stupid way to trade. Joe Biden would probably trade like that, but not me. I am an absolute genius. I would never do anything like that. Totally stupid way to trade. Now, because of this, probably from the moment that I put those trades on until the moment that I just got monkey hammered to death because of it, which we should trademark monkey hammer before someone else tries to take that. By the time we got monkey hammered, or I got monkey hammered, not you, you were smarter than me. By the time I got monkey hammered, I don't know how much I lost in my account, but I had no idea what I was doing. I did not have a buy plan. I did not have a sell plan. And I certainly didn't have a plan to take profits. You need to do that. You can follow my plan for sure. You can follow my plan, but you also need to adapt it to fit you. Right? I've worked with some of the very best traders in the entire world, and I don't follow their plan step by step. I followed what works for me, and I left behind the things that I don't care about, the things that don't work for me.
Perhaps 5%. Darvas makes a superb quote on stop losses and risk management when he says, "If you could play roulette with the assurance that whenever you bet $100, you could get out for $98 if you lost your bet, wouldn't you call that good odds?" This is such a...
Heck yeah. Right? So you got the roulette wheel and it spins. And if you lose, you're out $2. But if you win, you could make 100. I would bet on that all day. All day. That's how trading can be if you understand risk. I know it sounds crazy. It sounds impossible. Sounds like I'm a fake guru. Sounds like I'm a scammer. But trading can be that way. You can take $2 of risk. Yet when something works, you could make $100 in returns. Crazy, right? That's how the game is set up, if you know how to play it.
A strong statement which is not fully understood by beginning traders. Let's look at this in its simplest form. Darvas quotes the word odds, or often referred to as probability. In his example of roulette, assuming there were no zeros, if we were to make a $100 bet, there would be a probability of 50% as to whether the ball would land on red or black. In other words, you risk all your $100 to win $100, or you risk 100% to win 100%. So how does this relate to trading? And how does Darvas allude to us being able to move the odds in our favor? In roulette, there are no logical reasons as to why the ball would fall in either color. It's pure luck. Unlike trading, there are no resistance points on the roulette wheel, suggesting one color has a better chance than the other. Let's begin to categorize each scenario into gambler, novice trader, and professional trader. We know in this example we have a 50-50 chance and no control over risk or reward. Therefore, this is simply gambling. Next, we have the novice trader, who is able to understand some of the equation. They understand through price action that the breakout of resistance and the forming of support thereafter can provide a logical reason to enter a trade whilst putting the probabilities in their favor. Or in roulette terms, the likelihood of the ball staying in black rather than red and achieving a 100% return has improved. However, without a...
And look at that, right? 50-50 versus you make everything, you lose everything, or you make everything and you only lose a tiny bit. This is how the game is meant to be played. But most people consider it like this. Most people say it's Lambos or food stamps. Nothing in between. Either I'm driving a green Lambo tomorrow or I'm on food stamps and welfare. Bro, that's not how it's supposed to be.
To stop loss, the novice trader still takes 100% of the risk, just like the gambler. An improvement, but not the optimum strategy. Next, we have the professional trader. Like the novice trader, they understand the importance of support and resistance. However, the professional trader will also limit their downside risk by placing a stop loss. Using the 2% Darvas quoted, we might place the stop loss here, providing 100% or more upside and 2% downside. To recap, the gambler has no way of improving probability and no risk control. The novice, applying the box strategy, can improve his probability but has no risk control. The professional, also applying the box strategy, improves the probability and limits any downside risk.
And this is why you're watching my channel and not the Joker's channel and not whomever's channel, right? There are so many channels on YouTube, but I don't think you're going to find that many who fall into the pro trader category who understand what you've gone through. Because the other channels, we see them, we talk about their videos all the time, and we pull out the bullhorn and we call out their BS because they are basically telling you it is so okay to lose money. It is so okay. It is, in fact, I think AMD is a great buy. AMD is a fantastic buy, all the way dollar cost average into AMD. Just add losers on top of your losers all the way down. And eventually, trust me, bro. Trust me, bro. 5 years from now, this will all make sense. Trust me, bro. Or limit your risk. Understand that it has the opportunity to go up, but also has the opportunity to go down. And you as a professional trader need to know exactly how much risk you're willing to take and just get out of the way if it's coming back at you, right? Every time a trend starts, it starts on a bend. Every time a trend starts, it starts on a bend right here, like an AMD. And I want to highlight this because I had plenty of comments saying, oh, Chris, you said this was a bullish trend on AMD and it went back down. Bro, yes, the bullish trend started 10, 20, 50. It did start, but it didn't stay. And that's where the professional will say, okay, I was wrong. I'm going to move on. Or the amateur says, oh, well, I guess I'm holding on to this for a while. The problem is that we don't know how long that while is going to be. Could be months, could be years, right? Imagine you bought Elf Beauty. Imagine you buy Elf Beauty up here at $200 and now it's down at 61. How long are you willing to hold on to that? Listen, the longer you hold on to that, the longer you're not making trades that are working. And that's why I've been on this kick lately, is to say, you know, when you open your brokerage account, you should only see winners. When you open your brokerage account, you should see green, 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 green. You might see a red here and there, but it should be flooded with green. You should be overwhelmed with green. Why? Because the only trades that you keep are the ones that are working. The only trades that you keep are the ones that are still trending in the direction you want it to go. The only trades you keep are your winners. And you bounce your losers out as fast as possible. When you have that mindset, you no longer are cool with holding on to losers because those losers are bringing you down. We don't need that. The longer you hold on to a loser, the less time you get to spend holding on to a winner. And honestly, the less you get to trade with that winner as well. So it behooves you to get out of a losing trade as fast as possible.
Now we understand the logic. Let's apply the box strategy to a recent stock. Here we see the popular stock Amazon from 2016 to 2019. In 2016, we see a 52-week high here, followed by a bottom here. This creates the upper and lower lines of the box as we watch it form over time. The point of entry would be when the price is seen to break out above the box, seen here. A stop loss would be placed a few percent.
Right. And so this is trending higher, right? If we could draw some moving averages on it, and this is a weekly chart, but it doesn't matter. The moving averages are universal, right? Your 50 would probably look something like this. Your 10 period is going to look something like this. I got my colors wrong, but it's fine. Or maybe it wouldn't go that high, but you get the point. And then the 20 period would look something like this. Right. So it's going to cross moving averages at some point, and that's okay. That's totally okay. Because every trend starts when the 10, 20, 50 is moving in your direction. Does it mean you're going to catch the bottom 10%? For sure not. Does it mean you're going to catch the top 10%? For sure not. But you don't need to, right? You don't need to catch the bottom. You don't need to catch the top. You need to catch the 80% in the middle. That's where the money and the meat is.
Percentage points within the box, perhaps here. The trade would remain in play until the initial stop loss is hit, or until another box is formed, at which point Darvas would raise his stop and add another position. This is also known as pyramiding. As the trade progresses, we look for signs of another box formation. Here we see another 52-week high and a retracement to a bottom. Again, we can plot the beginnings of a box and watch it form until we see a breakout. We see the breakout, enter the trade with some more capital, and raise the stop accordingly. This process repeats.
If you're going to dollar cost average in anything, this is how you do it.
Until the trend eventually comes to an end. Here we see the price increase without any obvious signs of a box formation, and then turn down and cut through the raised stop loss. On closer inspection, it could be argued that a box formed at the very top of the trend, seen by a top and by a bottom, at which point the stock would have been sold as it pierced through the bottom of the box. In terms of risk-reward, and taking the first box trade in isolation, we can see the risk taken is remote in comparison to the eventual reward. The risk-reward ratio in this example would have been approximately 12-1. This is the recipe for success in the markets.
This is the recipe for success in the markets. Keeping your losers small and letting your winners run out of control. That's how it's done. But most people cannot do this.
And is the exact process Nicolas Darvas took to earn millions. Today, we found a qualifying chart from a company called Genus. We see a 52-week high and a retracement to a low, at which point we can form a box and once again watch it develop. Darvas suggested that we place a buy order a few points above the box in anticipation of a breakout. The breakout occurred at the close of this week, so it will be interesting to see how it develops. A stop loss would be placed within the box at a percentage you are comfortable with, perhaps here. Not forgetting that Darvas also wants to see some conviction on the breakout, and as such, he likes to see volume increase, which we do here.
So that is one thing that I don't look at. I don't look at volume. That's just personally one of the things I don't look at. I want to see at least 1 million shares traded daily on average, but I'm not looking at the volume candle on any particular day. And that's something that I've decided doesn't really fit into my trading plan, and I'm okay with that.
In my review of the Nicolas Darvas method, I have found the following. Darvas is predominantly a chartist, a trend follower, an excellent risk manager, and combines everything to put the odds of success in his favor. His box strategy encapsulates this into a fairly simple process and promotes discipline through its objective approach. I leave you with this final quote from Darvas. I have no ego in the stock market. If I make a mistake, I admit it immediately and get out fast.
And that right there, have no ego in the stock market. If you make a mistake, admit it and move on fast, right? And I think the problem with most YouTubers, except for this channel, is that they feel as if, oh, I said this stock has to go up $75 in this one stock and you'll be a millionaire. How many titles have you seen like that? I think they feel like, I can't be wrong. Then I'll look stupid on YouTube. Oh, I said that this stock has to go up from here. So if it doesn't go up from here, I'm just going to tell people to buy more because it has to go up. See, if I tell people to buy more, then it'll go up, right? Because if I have an audience of 800,000 subscribers and each one of them buys a couple stock, a couple shares, then, oh yeah, it's totally going to go up from here. Buy this stock. $75 in this one stock will make you a millionaire, right? I think that actually is how a lot of these other YouTubers think. Whereas I'll tell you straight up, I'm going to take this trade. I'm going to get out. Here's why I got in. Here's why I got out. Have no ego in the market. The market does not care what you think. The market does not care what your price target is. The market certainly doesn't care what your fair value is, right? The fair value of a stock is what the stock is trading for today because somebody thought it was a fair value and they decided to transact on that value. That is what fair value actually is. It's your choice. You can either listen to what the market's telling you, or you can tell the market needs to listen to you, and your pockets ain't deep enough. Your pockets are not deep enough. So I want to shift gears and go back to what we used to do. Now that the market is being a bit more cooperative, I want you to start putting your stocks in the chat and let's start looking at all of your stocks. Now, what I want you to do is put in the name of the stock and if you're long or bullish, right? So for example, I would be long AT&T or looking at long AT&T because I'm bullish. Or you can say, I would be short Tesla or Tesla bearish. I don't care how you put it in, but I need to know which direction you're looking. That's what I'm looking for. That's what I'm looking for. So while you do that, there was a couple of questions in the chat I'd love to answer. Rob asks, do you have to be an outlier? Do you have to be an outlier to attend OVTLYR University? Our first cohort, we are giving it exclusively to members of OVTLYR. And if you have not signed up for OVTLYR University yet, it is a free, 100% free, basically mentoring that we are going to do. It will be live on YouTube every day that we have these. And I'm not entirely sure which day and time it's going to be yet, but every time I want to work with you directly. So inside of our Discord, if you go to OVTLYR University, you can fill out the application right here. Now, each cohort will be limited to 10 members. And of those 10 members, right, we want you to be there. We want you to come with your camera on. We want you to ask questions. We want this to be college level education, constantly teaching you to go from zero to hero in the stock market. So the answer to that is yes. If you are an OVTLYR member, then you have the opportunity to be selected in the first cohort, right? We're starting with one and we're going to see how it goes from there. I'm very excited about that. Paul says, in your position spreadsheet on Coke, so let me pull that up here. So this is the position sizing spreadsheet. On Coke, you have risked 1250. So let me go back to here. So at 5% on $100,000, that's not 1250. I know it's $5,000, but it's by design to be less. By design to be less. You can expand this by changing where you're going to get out. If you got out at 1 ATR down, let's say you got out instead of 7180, you went down to 7080, right? That would expand. Let's say you got out at 70, that would expand. Let's say you got out at 65, that would expand, okay? It's by design to get you out with the least amount of risk possible, but the biggest size possible so that you can make as much as you can by design. So let me finish that question here. With 17 contracts, so looks like it's 19 today because the ATRs adjust a little bit. If I liquidate 17 contracts based on a half ATR, 90-cent drop, my asset price, my actual loss is more than 1250. The math here is current price minus half ATR times number of shares. That's the math on it. So I'm not sure where your math is coming from, but that's the math on it. Your current price that you got in minus the half ATR price, that would be stop loss price times the number of shares. That's a 1250. And so as far as options go, I just let the options take care of themselves. That's how I look at it. I'm not really that miffed on it. I'm going to let the options take care of themselves. Ryan says, if you decide to pull the trigger on AT&T, will you do that in the afternoon video? Yes. Now, I put every single trade that I make in the Discord on the OVTLYR trading room. So every single trade I make is in here, and it's been in here for years and years and years and years and years. Now, I haven't traded in a hot minute. When's the last time I traded? I think it was like March 2nd was the last time I traded, March 5th. So I haven't traded in, geez, nearly 2 entire months at this point. And this is why. This is why I haven't had opportunities, because the market has not been cooperating, and that's okay. So every trade that I put on, I will send into the Outlier trading room as I do it, but I'll also be doing it live here on YouTube. So if you care about the trades I make, and you may or may not, I will be doing them live in the afternoons, and then the replay will go out the following morning. And of course, you can always tune in and tell other people about it as well. Mikey Mike says, can you share your 8 indicators you're using on TradingView? For sure. So first, as the 50 EMA, that's the red line. The 20 EMA, that's the black line. The 10 EMA is the blue line. Next, this is a custom one that I created. As we talked about a moment ago, ATR levels here. Half ATR is my stop loss point. 1 ATR is where I look to roll. 2 ATRs is where I look to roll again on my options. Beyond the scope of this conversation, but I actually built these little dudes right here that show me my lines as of right now. Now, of course, they move based on the price and the day. So I need to go in and you know, add a line like this. So I'll go in and put like opening line right there, and then another line, and then I'll say it's a +1 ATR line like that. And then they'll stick, because I'll have to take this off. But I have one that's for bullish and bearish, and I actually wrote this. I didn't write it. I had ChatGPT write it for the Pine script. So you could ask ChatGPT to do something like that for you. I have volume, which is there. I don't really look at it, but that's there. And then I have order blocks on here. Now, Rick Warfish, one of our members in the Discord, he actually sent me the code for this. So he would be the person to get that code from. But it nearly identically matches the Trend Spider order blocks. And in fact, I sent this code to Mahesh, and I said, Mahesh, I think we need to use this code for our outlier blocks, because it seems to fit a lot better. So those are the 8 indicators. What happened in TradingView? TradingView is just for the actual trades themselves, my friend. TradingView is just for the actual trades themselves. So this is where I'd get the options chain, or if I were to buy stock, that's where I'd do it too. Guy Incognito says, what determines an institutional trading block? How would you know if it's institutions buying? It's volume. It is volume, right? Because these are areas where swings have happened. And the only way that swings have happened like this are large institutional orders, right? My orders are not going to be big enough. Your orders are not going to be big enough. But Fidelity's orders, they're going to be big enough. The Magellan's funds orders are going to be big enough. Hedge fund orders are going to be big enough, right? Those are the ones that move the market. And we just need to follow along with them. Another question from Michael. If we want to get into a trade on a stock, but the open interest is like 100 or less, is it better just walk away, or maybe just buy shares instead? It's a fantastic question, Michael. So for me, I have this criteria right here. I like to start at 21 days. So let's go to AT&T. This is AT&T, the little T right here. Let's start at 21 days. Now, May 16th is 17 days away. I also only look at regular expirations, which is the monthly expirations, if I can make a trade. Sometimes I'll add in weeklies, but generally the monthly contracts are the most liquid. So that's where I start. But if I need to adjust, I'll add the weeklies in. But to his question, if it only has like 100 open interest, should you walk away? I would, and I do. Right, I would be more interested in the 94 delta with 264 in open interest versus the 81 delta with 49 open interest. Why? So I had a mentor of mine tell me one time, you need to make sure that the options chain strike that you're getting into is 4 to 6 times as big as your position, right? 4 to 6 times as big. Now, if you're getting into AT&T with 100 contracts, you need to be looking for maybe 400 or more. If you're getting into AT&T with 5 contracts, you need to be looking for like 20 or more, right? So that's up to you. But the point is that you need to make sure that you have liquidity to get in, and you have liquidity to get out, and you don't have any issues. You don't have any issues, right? You don't have any liquidity issues where you're stuck. So it's a fantastic question. Yeah, I will absolutely just walk away. And I do it all the time, and it's no stress. Philip says, there's another dip I avoided because of Outlier. I found you when I was at the peak of Mount Stupid. I am so grateful for that. There's so many people still sitting on the peak of Mount Stupid. Unfortunately, a lot of those people have a lot of I wish I shouldn't say stupid YouTube subscribers. A lot of people who are standing on top of Mount Stupid with that particular YouTuber saying, oh yeah, we're so smart. Why is my account balance going down? We're so smart. But why does my bank account look smaller than it did yesterday? We're so smart. Does this guy actually know what he's talking about? Yeah. Golden Oldie, what's up, dude? It's okay to be wrong. Just not stay wrong. Francis said, I DCA'd into gold when it was going up, and my winning trade became a losing trade. Now, I'm really glad that Francis brought this up, because if I go to GLD, I'll tell you one thing I don't like about TradingView is all of these choices. Oh my gosh, it's overwhelming. Because now, like if I just do GLD and all, it's like hundreds of choices for GLD. I don't like that. That's too many. So I have to go to funds and then GLD. That's annoying. That's annoying. So I actually like to do lump sum investing. Now it's not full portfolio, right? This would be lump sum investing where I'm taking one position, right? For example, I might be taking 119 shares or maybe one option contract in Tesla. Okay. That's what I would be doing. And I have found, and I got really burned and frustrated by this, that when I would do multiple positions, so let's say I put one on here, one on here, and then one on here, and then one on here. Come on, the clicks are not as good. I would get really frustrated because while I added 1, 2, 3, 4, when it turns around like it did right here, my 2 winners stayed on, but now I have 2 losers working against me. I hated that. I hated watching a nice big winner turn around. And it's like you send one train out from the station and you got 2 trains coming back at you, right? Those 2 trains hurt a lot worse than the one going out. So I no longer DCA up into a trade because I'm not looking for long-term investing. I'm looking for an opportunity, and I will get into that opportunity and I will get out based on the signals. So yeah, it's totally a thing. I get it, and I have experienced that, and I understand why it's frustrating. All right, let's do this. Tradesman said, I had a timeshare amount stupid. Manny says, my face was carved into Mount Stupid. No, you guys are smart. That's why you're here. That's why you're watching this, because you realize something wasn't right. You realize something wasn't right, and that's the important part. Let me close a couple tabs up here, and we'll get busy. All right, let's go. Corey wants to look at Netflix long. So first, we're going to look at an outlier in FLX. And we're going to look at a few things. So first off, the market has not quite turned, right? The market still has a bearish trend on it. Because of that, don't try to tell the market what it's going to do. Listen to what the market's telling you. When we close over 555-ish, all is going to be green lights for me. That doesn't mean it's going to continue on forever. That just means the trend has reversed, okay? So your 10 will be over the 20, price will be over the 50 at that point. But I don't know how long that will last. Maybe it'll last for months, and hopefully it will. But looking at Netflix, has a buy signal, came on April 14th, so a couple weeks ago. So that's a great start. Getting way more greedy. That's what you want to see. The sector getting less fearful, moving towards greed, and the sector breadth moving up as well. Dude, other than the market not being trending higher, Corey, this is a really strong trade. A really strong trade. I love it. Centurion Investing wants to look at Celsius. And I specifically picked this one on purpose because we have a lot of noise on this one. And I want to show you what I mean by noise. We have a lot of noise on this one. A lot of noise. A lot of buy, sell, buy, sell, buy, sell, buy, sell. So objectively, we want to make sure that we don't get into a situation like this. Now, one way we can avoid that is by buying stocks that have the greed going higher, right? Because right here, the greed is going lower. The greed is going lower. The sector is getting less fearful, more greedy. The sector breadth actually has peaked and is going the opposite direction. But a lot of this noise can be avoided by making sure it's moving more greedy, as well as the market trend and the stock trend, right? So I wanted to point that one out specifically. For me personally, I wouldn't own this one, because we do have the 1020 cross, it looks like. Maybe even price under the 50. Let's look at Celsius real quick. Yeah, your 1020 looks like it's about to cross. And because of that, I would not be interested. I would not be interested. And the sector is also getting more. The sector breadth is also showing more sell signals. Let's look at Tesla long for Bjorn. Now, Tesla, we got a lot of flack for in 2.0 because it had a buy signal that did not cross over back for a long time. But right now, Tesla has really, in 3.0, a lot better signals here. In fact, if we look at the performance summary, it shows OVTLYR with 1,296% returns versus buy and hold at 457. That's not too shabby. That's not too shabby. OVTLYR buy and sell signals like that. So if I zoom in right now to the 3-month chart, we can see we got a buy signal April 24th. Do we have the crossovers just yet? Yes, it looks like today Tesla's crossed over. And it's getting less fearful. And the sector is getting less fearful. And your sector is also showing stronger market breadth. So Tesla's actually looking really strong for me. Tesla's looking really strong for me. Quentin wants to look at snow. By the way, put a 1 in the chat if you're glad this is back, or a 2 in the chat where it's like, meh, I don't care. When we look at charts, I really want to know this. I haven't done it in a minute because the market had been uncooperative. But a 1 in the chat if you like us looking at a bunch of charts like this. A 2 in the chat if you're like, nah, I could pass. Okay, so looking at snow, got a buy signal here. Performance summary shows OVTLYR positive 34%, where buy and holds at negative 20%. So crossover here, 10, 20, 50 with a buy signal, getting less fearful, even a bit greedy. The sector getting less fearful, and then your sector breadth is looking strong. So yeah, snow looks good to me. Snow looks good to me. But remember, the market has not quite crossed over, but it totally could today. It totally could today. Everybody's throwing 1s. Okay, cool. I appreciate that. I am really glad. We're going to be doing this again. Okay, excellent. Susan says, I love looking at charts. Very cool. I'm glad. And this is the thing, right? Like, what 10K do I need to look at? What annual report do I need to see for any of this? None of it. None of it. It doesn't matter. What dollar cost or what net present value should I look? What future value should I hold? What cash flows does it matter? It doesn't. None of that matters. Ooh, Ross says, I listened to Henry and sold options until January 24th, and you only lost 10%. Bro, I'm so stoked for you because I blew up my account twice selling options. Twice. Thinking I was the genius. Thinking I was the genius, yet blowing up my account twice. Yes, Deep Thought was giving me some how to use things yesterday. I appreciate that, Deep Thought. Okay, let me look at a few more stocks for you guys. Let's look at well, Deep Thought. I'll give you a little payback here. SMCI. All right, sitting on a buy signal. We've got it getting less fearful. We've got the tech sector getting less fearful. We've got the tech sector having strong market breadth. And then if we look here, we might have that 10, 20, 50 crossed over. Yeah, maybe today that 10, 20, 50 is going to hold as a crossover. You got earnings in a couple days coming up, though. Now, this is actually one of my favorite plays, is to trade up into earnings. So we'll see if that pulls through. But due to my side, it looks sharp to me. Ham360 wants to look at SoFi long. I know SoFi had earnings this morning. Let's take a look at SoFi. I'll give you a little game plan on this too. So SoFi is up 6% right now post earnings. What I want you to do, Ham, is at the end of the day today, I want you to take a line. I don't care what color that line is. And I want you to put that line at the bottom of today's candle. Now, why am I telling you to do this? Because there is a phrase in trading called gap and crap and gap and go. Gap and crap is where it'll go something like this, where it gaps up. And it might even continue up a little bit, but then it falls back down. Okay, we don't want that to happen. A gap and go is where it comes up and it goes up, right? Gap and go versus gap and crap. Let me show you a couple examples, a real life example. Let's look at Celsius. That was one where this was a gap and crap, right? It gapped up. It was something like 30% it gapped up, and then it came right back down. And then, of course, it did go up later. We see that. But at the time, we don't know how much further this is going to go. Okay, we don't know. So that's why I say put a line on the bottom of that candle. Put a line on the bottom of that candle. Put a line on the bottom of the candle, Trading View. There we go. Put a line on the bottom of the candle. And then if it breaks through that line, all bets are off. We don't know what's going to happen with that. Let's look at one where it's a gap and go. Palantir had a gap and go. A gap and go. It did not close under this candle. It gapped up. It got close, but then it went. Now, other news came out later, but this is what you're looking for. Gap and go versus... I've still got to get used to this. Gap and crap. Right. So back to SoFi. We don't know which direction it's going to go yet. So let's remove. Where's remove? Okay. There's remove. And there's remove. There we go. So had that line to the bottom of this candle and watch where it's going from here. Now back into OVTLYR on SoFi. Got a buy signal a couple days ago. That was good timing, right? Buy signal a couple days ago. You got your 1020. Oh, duh. I need to look at the overlays. That helps me. The green overlay represents the 10-20-50 going north versus going south. It's getting more greedy. The sector's getting more greedy, and the sector breadth is looking strong. So listen, SoFi looks really sharp to me. SoFi looks really sharp to me. I know a lot of SoFi bros are looking forward to that today. Now, listen, I'm looking forward to seeing you in this afternoon's live stream. I might be trading AT&T today. We'll have to see how the market plays out. I'm not going to tell it what to do. I'm going to let the market tell me which direction it's going. I'm also going to tell you to click one of these two buttons right up here. One of these two videos right here is going to be the best video you've watched all day. I believe it.